Hanging over the markets is the Fed. While a rate hike is widely expected in July, the debate on Wall Street's already focused on what's going to happen in the fall. Here to discuss is David Spika, president of Guidestone Capital Management. David, is this market yet factoring in rates staying high?
Oh, absolutely not. The market is now trading above where it was when the Fed started raising rates in March of 2022. I think the market, again, is looking at a soft landing, which means lower Fed funds rates. So a lot of optimism around the CPI report this week. That's leading people to believe the Fed will be lowering rates maybe by year end. And I think that's what the market's factoring in. It clearly is not factoring in a 5% plus Fed funds rate for a sustainable period.
Given how strong things seem, I mean, relatively speaking, I don't understand the scenario where the Fed is cutting rates. Not hearing that yet. What does that mean about the attractiveness of fixed income here versus equities?
Well, fixed income is very attractive. We've got yields, particularly at the short end of the curve, as high as we've seen since 2007. And the other thing that we thought would be attractive would be less rate volatility. Now, we've continued to see a lot of rate volatility, but you're being compensated by that yield. So fixed income investors today, particularly in higher quality fixed income, because credit spreads are very narrow and subject to widen out, those in higher quality fixed income are in a great shape. And again, attractive yields like we haven't seen since 2007, and something that's a great place to be today if you're worried about volatility in the equity market.
Where else, though, would you be if you are willing to take on a little bit more risk when you're looking at the equity market? What areas or stocks in particular are attractive to you?
Well, we would favor companies that have visible earnings growth. And we've really seen year to date growth outperform value. We think that's likely to continue because when growth becomes scarce, which we believe it will, investors bid up growth stocks. And so companies in the technology and healthcare space are areas that we feel like will do well. They've got visible earnings growth, notwithstanding the run tech's had year to date. But if you're selective and pick good companies that have that visible earnings growth that are high quality, I think you can weather the storm fairly well. Can
you be selective for us and give us some names? I mean, tech is a fairly broad recommendation.
Well, I want to go ahead and go with Microsoft, one of the ones that's run the table this year already. But you've got to invest in something that has AI exposure. You just have to today. This market reminds me a lot of the late 90s and early 2000s. You had the Fed raising rates, you had valuations at an extreme, a very concentrated market, and a new technology, the internet. And those were the companies that benefited from that. So today, it's AI, and Microsoft is one of those companies that's well positioned to benefit from the growth of AI.